Everyone loves bull runs. That feeling when Bitcoin surges 20% in a week and altcoins double overnight. But history shows what follows is often painful. In 2021, Bitcoin went from nearly $69,000 to under $20,000 within a year, wiping out more than $2 trillion from the crypto market. That's the harsh reality of volatility. What if you could protect your gains during those crashes without converting to fiat or missing future upside? Professional investors do exactly that by using stablecoins and derivatives. These aren't tools for gamblers. They're instruments for managing risk. By the end of this explanation, you'll understand how experienced traders stay profitable, whether the market is going up, down, or sideways. The essence of hedging is simple. It's insurance for your portfolio. You're not trying to predict where Bitcoin goes next. You're making sure that no matter what happens, your net worth doesn't get crushed by volatility. Crypto markets are among the most volatile in all of finance. For context, the average daily volatility of Bitcoin is around 4 to 5 times higher than that of the S&P 500. Ethereum and altcoins swing even more. This means that a 20 to 30% correction can happen in days, sometimes hours. Investors who remain fully exposed to crypto assets without any hedge experience, extreme drawdowns, and emotional stress. During major sell-offs, fear replaces logic, leading to panic selling at the worst possible times. Hedging solves this problem by providing stability without abandoning your position in the market. It's about protecting value, not predicting price. Think of it this way. You can drive a high-performance car at top speed, but you still wear a seatbelt. The seatbelt doesn't slow you down. It protects you if things suddenly turn. Similarly, hedging allows investors to keep their exposure to long-term opportunities in crypto while minimizing short-term risk. Professional traders, funds, and market makers all hedge their positions regularly, not because they expect losses, but because they know markets can turn fast. By incorporating tools like stablecoins for partial risk-off allocation and derivatives such as futures or options for downside protection, they maintain control over their portfolio's volatility and protect profits when sentiment shifts. One of the simplest and most effective ways to hedge crypto exposure is through stablecoins, digital assets pegged to a stable value, usually the US dollar. Popular examples include USDT, Tether, USDC, Circle, and DAI, MakerDAO's decentralized stablecoin. The key idea is this. While Bitcoin or Ethereum may fluctuate wildly, one USDC or one USTT will generally remain worth around $1. By converting a portion of your portfolio into stablecoins, you can temporarily step out of volatility without leaving the crypto ecosystem. Let's take a practical example. Suppose an investor bought one BTC at $30,000 and now it's worth $60,000. Instead of keeping the entire holding exposed to the next market swing, they could sell half into USDC. If Bitcoin crashes back to $30,000, the stablecoin portion stays untouched, effectively preserving half the portfolio's value. This is not about selling out, but about locking in profits and reducing exposure. What makes stablecoins particularly useful is that they don't need to sit idle. In decentralized finance, DeFi, stablecoins can be deployed to earn yield through lending or liquidity provision. Platforms like Aave, Curve, or MakerDAO allow investors to earn 4 to 10% annual yields on stablecoin deposits, far higher than traditional savings accounts. During bearish phases, many investors move into stablecoins to generate passive income while waiting for better market conditions. There are, however, different types of stablecoins, and understanding them is critical for managing risk. USDC and USDT are fiat-backed, meaning they're backed by reserves like cash or treasury bills held by centralized companies. DAI, on the other hand, is crypto-collateralized, backed by assets like ETH and USDC, locked in smart contracts. Fiat-backed stablecoins offer stability and liquidity, but come with regulatory and centralization risks. Decentralized ones are censorship-resistant, but depend on the health of the collateral market. While stablecoins provide a simple way to step out of volatility, derivatives allow investors to protect their holdings without selling them. Derivatives are financial contracts whose value is derived from an underlying asset. like Bitcoin or Ethereum. In crypto markets, the most common derivative instruments used for hedging are futures and options. These tools are used extensively by institutions, hedge funds, and professional traders to manage risk, balance exposure, and even generate income in uncertain markets. A futures contract is an agreement to buy or sell an asset at a predetermined price on a future date. In crypto, perpetual futures are the most popular type. They don't have an expiry date, and their price stays close to the spot price through a funding rate mechanism. Platforms like Binance, Bybit, and OKX allow traders to use futures for hedging. Here's how it works in practice. Suppose you hold one BTC in your long-term portfolio, currently worth $60,000. You're bullish long-term but worried about a potential short-term correction. Instead of selling your Bitcoin, you can open a short position in BTC perpetual futures for the same amount, one Bitcoin. Now, if Bitcoin drops to $50,000, your spot BTC loses $10,000 in value, but your futures short gains $10,000, effectively keeping your net exposure neutral. You've successfully hedged against the downside. This is known as a delta neutral position, where the gains from one position offset the losses from another. Professional traders and funds use this technique constantly, especially around high-risk events like Fed meetings, ETF announcements, or halving cycles. The key benefit is that you can maintain ownership of your Bitcoin for long-term gains or staking rewards while protecting its value in the short term. However, futures trading requires discipline. Over-leveraging can turn a hedge into a speculative bet. The funding rate, a small fee paid between long and short traders, can also affect profitability if the position is held for a long time. A positive funding rate means shorts are paid, while a negative one means you'll pay to hold the hedge. So understanding market conditions before opening a futures hedge is essential. For investors who prefer defined risk, options offer a more flexible hedging tool. An option gives you the right, but not the obligation, to buy or sell an asset at a specific price within a set time. The two main types are call options right to buy and put options right to sell. For hedging, investors typically use put options, which increase in value when the underlying asset's price falls. Let's take an example. You hold 5 ETH currently worth $3,000 each and want to protect against a drop below $2,500. You could buy a $2,500 put option on ETH expiring in 1 month. If Ethereum drops to $2,000, your holdings lose $5,000 in value, but your put option could gain a similar amount, offsetting the loss. The only cost to you is the option premium, the price paid to buy the option. Think of it like paying for insurance. If the market doesn't crash, your premium is the cost of staying safe. Options trading platforms like Deribit, OKX, and LedgerX, for US users, offer these instruments. Many institutional traders use protective puts or covered call strategies to manage volatility and enhance returns. A protective put limits your downside risk, while a covered call can generate extra yield on assets you already own. Unlike futures, options don't require ongoing margin management, and your losses are limited to the premium you pay. No liquidation risk. However, the trade-off is cost. In high volatility environments, option premiums can be expensive. This makes them ideal for hedging short-term risks or during periods of extreme uncertainty, rather than as a constant strategy. The most effective investors don't rely on a single hedge. They combine stablecoins and derivatives to balance safety and opportunity. A simple structure could be 70% in core holdings like BTC and ETH for long-term growth, 20% in stablecoins to lock in profits and provide liquidity, and 10% in derivatives for downside protection. This mix allows you to stay invested while having capital ready for dips and tools to manage volatility. For instance, an investor could rotate part of their portfolio into USDC after a strong rally, open a small short futures position on Bitcoin to guard against near-term corrections, and use those stablecoins to earn yield in DeFi platforms. This way, even if prices fall sharply, the portfolio remains steady and liquid. The aim isn't to eliminate risk, it's to control it intelligently so you can stay in the market long enough to benefit from long-term growth. Hedging isn't about predicting crashes, it's about preparing for them. The market will always move in cycles, but with stablecoins and derivatives, you can make those cycles work for you instead of against you. Whether you're managing a small portfolio or a fund-sized position, having a hedge strategy separates professionals from speculators. Remember, in crypto, it's not just about how much you make,